Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, we have Brian Joyce. He is the managing director at Nasdaq's Market Intelligence Desk and our resident chart technician. So we have a number of charts we're going to run through today. Before we get into the charts, Brian, looks like we're back nearly all-time highs with some more China headlines coming out.
Yeah, we had a little bit of weakness yesterday morning. We filled the gap from Monday, but we bounced right off it within a point. And now, the Nasdaq, the S&P 500, breaking out to new highs.
All right, let's go through our charts. We have a number to get through today. The semiconductor index, what we affectionately call the SOX. We've been following this one, and it looks like it has broken above some key levels that you were tracking.
Yeah, this is the weekly period chart. So each candlestick is 5 trading sessions, and you can see the last 3 weeks it's been marching higher. Broke out above that 1600, 1605 resistance that's been in place since about April or so. We broke out of that last month, and so we're marching higher. Tactically, it's a little bit stretched right here. The weekly RSI is up at the 70 level. Mm-hmm. That's certainly reflective of the bullish price action and a positive signal in the intermediate to longer term. But right now, I'd be cautious about maybe chasing it right here.
It seems to be reflective of the U.S.-China trade headlines, particularly when they're positive, which is why our next chart, which is the Shanghai Composite, I would imagine would reflect some of that as well.
Yeah, so this chart, there's a lot going on right here. So I'll start out with how at the beginning of the year, over the first three and a half months, the Shanghai was up 35%. It was leading all global indices, massively overbought. The weekly RSI hit an 85. When it actually hit its peak, the RSI was making a lower high, so there's your bearish divergence, and we had the pullback. The pullback bottomed right here in August at exactly the 61.8% Fibonacci retracement, which is a common support level. And now that we look at it now, what we see is the index has been peaking at around 3,050 level, which is where there's a gap. So gaps tend to be future levels of resistance or support, in this case resistance. And twice we've tested it, back in the midsummer and here again in early September. And so right now we have a bit of a triangle pattern on the right side. And over the, let's say, last 4 or 5 months, it's been forming a inverse head and shoulders bottoming pattern. So the right shoulder is where that triangle is. So the key level here right now is the 3050 level, 3050 level. Mm-hmm. We're a couple % away from there, but if we get a breakout above there, it's up about, the minimum price projection is up about 12% from here, which will take you back to about those highs that we had early in the first quarter.
All right, let's move along to the U.S. dollar. The dollar index here, the Dixie. This is another interesting chart as well, because you think there could potentially be a double bottom pattern forming.
Yeah, and that is the case. We did have a double bottom, so typically the dollar is seen as a safe haven asset. So that over the last few weeks, as a number of these industries and sectors have been breaking out, the dollar index bottomed actually around October 18th or so, and then retested those lows on November 1st. So it's a bit of a divergence here. Historically, the dollar is somewhat inversely correlated to risk assets. Those correlations do change, and so I don't want to put too much weight into that.
Right.
But it is certainly noteworthy, and given how much many industries are extended right now, we've seen a lot of RSIs in the high 60s and low 70s, if not higher. As we were talking earlier with the SOX index, this to me makes me want to be a little cautious about chasing the runs.
Because it's interesting, commodities typically trade the inverse as well, and you see oil up and you see a number of the metals up, and that's usually not the case when the dollar's moving higher.
Yeah, so we'll have to see kind of what this means. There is a lot always going on in Europe. This basket is heavily weighted to the euro, so maybe this is reflective of the fact that they punted the Brexit into January, so maybe that's what it is. So that's why I don't want to put too much weight into it. And like we said, correlations do change, with the dollar versus oil and the dollar versus risk assets overall. So don't want to put too much weight into it, but something that I do want to, highlight. And then if we look at the interest rate complex, which I think you're going to take us to with the next chart, kind of arguing the same thing right here.
All right, well, let's take a look at the 10-year to wrap up here.
Yeah, so the 10-year yield certainly looks bullish right here, making higher lows from August into October into November. But we are entering now a key resistance level in the 194 to 2% range, which marked the highs back in September at 194, and the 2% level, it's a psychologically round number. It also marked the low back in July over here. The RSI is in that upper 60s range. We're coming up to the 150-day moving average as well, which is at 199. So over the intermediate term, you could certainly say this is a constructive looking chart and argues for a potential breakout. But on the very short term, tactically, I wonder if we're about to see a bit of a pullback.
Now, is this where the curve is tied to now that it's normalized again? Is this why we're seeing a little bit more normal action in the yields?
Absolutely. So we put this out in our October monthly report. The yields curve, the short end is now anchored. The Fed cut rates for a third time a week or two ago, and they made it pretty clear that it's going to be a very high bar to either to cut rates further or even to move rates higher. The Fed wants to see persistent inflation above 2%, not just at 2%, but persistently above 2% before they think about raising rates. So we know where the short end now is anchored in, and now that the 10-year and the 30-year are kind of breaking out or moving higher to the top end of, say, the 6-month range or 3 to 4 month range, that is re-steepening the curve. So.
Brian, thank you so much as always for joining us at MarketSite, and thank you for joining me on Trade Talks. I'm Joe Malandrino, Global Markets Reporter at Nasdaq.